everyone, welcome back. We are studying insurance markets and adverse selection problem. I will give you an example of how adverse selection can actually lead to a failure of insurance markets. So in 1980s, California health insurer Health America Corporation was rejecting all applicants who lived in San Francisco. Company's belief was that AIDS was too prevalent in that area, and they pretended to review applications for 3 to 4 weeks, and then they reject all applications. So private companies can actually look at your application and reject your insurance policy application. Did you know that? So this is a market failure because with full information, individuals were likely to buy insurance at the actuarially fair premium, even if the premium were higher due to AIDS. Okay, so let's say somebody has certain heart condition and they're willing to pay higher premium if that heart condition is going to cause more complications and more insurance utilization. Okay, so this is an example of how health insurance markets can fail. So question, does asymmetric information, what was asymmetric information? Insurer and insured have different information regarding the risk of the insured. So insured knows more about themselves than the insurer does. So this can cause asymmetric information. So it doesn't necessarily lead to market failure. It doesn't if most people are risk averse. Risk averse means they do not like risk. So they pay for insurance above the actuarially fair price. I am a little bit like this. And pooling equilibrium occurs, all types of people buy insurance. So keep this in mind. Second, insurance company can offer separate products at separate prices, so consumers reveal their true types, careless and careful. For instance, I tend to buy full coverage for my vehicle and I tend to drive really carefully. Okay, I'm a careful driver. Yes, I like risk. I ride a motorcycle, but I thank God I survived all these years, right? That means I'm a careful rider too. So you can separate. And sometimes car insurance companies also separate drivers based on, do you know what they do? They put a machine in your car, it detects your driving, or it's an app through your phone, detects your driving if you go too fast, if you brake too hard, if you drive zigzag, go in and out of traffic. So they will increase your insurance premium because you're careless. Or car insurance companies start giving you a low premium. If you get into an accident, next time it gets renewed, they increase your premium. So these are the ways they separate you. So this leads to the separating equilibrium. So you charge careful people less, you charge careless people more. It is still a market failure though, okay? Charging everybody whatever you want. Insurers can also force the low risk to choose between full insurance, high premium, or partial insurance. So this is a market failure because we want full insurance. Insurance is offered to both groups, but low risks don't get full insurance. So this is also suboptimal. So I have full insurance, I'm low risk, I have full insurance, that's optimal. So if you are a little bit confused about separate products, separating pooling equilibrium, go to this is part 4, right? Go to previous part 3, where we actually study different types of full information, separate asymmetric information, separate insurance, and charging people average. So this part is really important if you missed it. So let's work on a question. Which of these statements is true? Chief role of federal government has historically been promoting the general welfare. People desire consumption smoothing because of diminishing marginal utility. Adverse selection invariably results in market failure. First of all, last slide told us this is not true. Adverse selection doesn't have to, asymmetric information, adverse selection doesn't necessarily lead to market failure, especially in this case. So that is incorrect. Chief role of federal government has historically been promoting general welfare. This is incorrect. This wasn't the chief role in the past. People desire consumption smoothing because of diminishing marginal utility. This is correct. So 2 only is the correct answer. The others are not correct. I will see you in the next part, 5. Part 5. Oh my gosh, I keep saying it wrong. Part 5. How does government address adverse selection? I'll see you then. Bye, folks.